8.9%. That's how much oil actually explains inflation. It's not 50, it's not 80, 8.9. This is 65 years of data, and right now with the 𝗕𝗏𝗧, oil up 35% in a week. People are saying this is the 1970s all over again, where there was enormous inflation. But the data says that's unlikely to happen, because what oil actually does in this environment with this backdrop isn't cause inflation. It does something much worse, and probably much worse to our Bitcoin bags. This video is for information and entertainment only. It reflects my personal opinions and is not financial advice. Check the description for more information. Always do your own research. Let me quickly run through what's happening. I'm sure you've seen it in a million different places, but the scale of this is easy to underestimate. The Strait of Hormuz is shut. 5 tankers have been hit, 150 ships are stranded, and Iran is telling every vessel that passes through it's going to set it on fire. Insurance companies are refusing to insure tankers to go through. This isn't just an issue for ships coming out. Of course, ships going into the area as well, delivering food and essential supplies, have been shut off too. So nothing's going in and out. It's a big problem, obviously. But it's not just oil. Qatar's LNG complex, which is the world's largest, has been offline since March the 2nd. South Korea said it could run out of gas in the next 9 days. Fertilizer prices are up 30%. Jet fuel is up 52%. UK gas is up about 70% too. This feeds into everything. And every product you buy has oil in it in the supply chain somewhere. If it's shipped, if it's wrapped in plastic, if the factory runs on electricity, oil is baked into the price. And when oil behaves like this, it's not petrol at the pump, which is the biggest issue. It's a tax on the entire economy. And so everyone keeps saying this is like the 1970s, but let me tell you what happened in the 1970s briefly, because I think most people hear that phrase and don't know the details. So oil went from $3 to $30 over the decade. Absolutely wild. Home prices tripled. If you had $1,000 in 1972, it was worth $400 by 1982. Inflation was rampant, like 7 to 13% for years. So savings got absolutely destroyed in real terms. And that's what everyone's scared of right now. But here's what no one's talking about, which is why the 70s was so bad. The reason inflation sustained so badly in the 70s wasn't oil. It was money supply. The M2 money supply, which is the total amount of money in the system that people can really access and spend, almost like money in their back pockets, grew 154% over the decade. Banks were lending aggressively because it's not just central banks that issue debt. Actual banks issue debt, right? That is really where money creation comes from. As long as banks can issue debt, as long as people can take that debt on, then the money supply continues to inflate. Now, wages were keeping up with prices as a result of this. So when costs went up, people could still afford to buy things at that higher price. Demand stayed strong. And that's what allowed inflation to sustain. Now, look at 2026. M2 has grown about 3% in the last 4 years versus 154 back then. Consumer savings are at record lows. People are drawing on their 401ks just to pay for their heating. People are running on fumes before this oil shock has even arrived. In the 1970s, people could afford to keep buying at higher prices. Today, they can't. And this is the key to understand that underpins everything. This is the actual data. This is the CPI basket and what it's made up of. This is what inflation is truly measured by the Federal Reserve, by any normal measure of inflation uses this, the CPI. And yeah, you could argue that this is not very useful because they pick and choose what they put in it, and actually asset prices should be the true barometer of what is and isn't inflation. I would agree. But regardless, right, oil makes up 7% of this basket. And yes, it makes up a bit more. It makes up 7% of the weight, but it contributes about 9% like we saw at the start. But look, this is 65 years worth of data. And every single month on this chart here that I'm about to show you is 1 month. Every dot is 1 month. On the bottom, oil's monthly move. And on the side, we've got CPI. All right, so green dots mean they moved in the same direction. Red dots mean the opposite. And so look at it. There's definitely some correlation. There's definitely some signal. But it's not incredibly strong. And this is where we get that idea that oil explains about 9% of what inflation does. Yes, it makes up more than its little pocket of 7% that it's meant to be inside that CPI data. But it's not 80% more, 90% more. This oil versus inflation is a weak signal. It's there, but it's weak. There's almost, not quite half and half, but maybe it's 60-40, right? Sometimes it's correlated, sometimes it's not. Now look at this chart here. This is the M2 money supply growth against the same thing, against CPI. Instead of oil, what you can see here is that with the same 64 years of data, it's almost all green. There's a clear upward slope. More money printing, more inflation. Less money printing, less money pushed into the economy, less inflation. Tighter credit conditions, less inflation. Looser credit conditions, more inflation. This isn't surprising. This is exactly what it should be. The point remains, when you see oil ripping, in the absence of loose credit conditions, you're likely going to see people struggle to go and actually have the demand to continue to keep up with the price rises. And the bond market, the largest market in the world, agrees with this take. Here's a quick bit of maths. 7% comes from CPI, right? 7% of CPI comes from oil, comes from energy. A 35% oil price move, you would expect inflation to increase by about 2.5 percentage points. But that isn't what the bond market is saying is likely to happen. And so there's a particular kind of bond you can buy. If you don't know what bonds are just lending money to the government and the government promises to pay you back. Obviously that's like an asset, right? Because you give the government money, they're going to pay you back in the future a bit more than you paid them. It could be 4%, could be 5%, depends on the rate that the Federal Reserve set, on the rate that the particular bond auction is set at. Now, actually it doesn't depend on the Federal Reserve at all. It depends on the rate that the auction, that bond is bought at. But anyway, right now you've always been able to buy these particular kinds of bonds called TIPS. They're called Treasury Inflation Protected Securities. It's a bunch of jargon. Basically, what it means is you lend the government money. The government promises to pay you back money in the future, but it will pay you back a certain amount more than inflation. So you're inflation protected. Now, if inflation doesn't really happen, and actually there's deflation or inflation is less than what is expected, then you get paid less in the future. So these aren't just like a risk-free, make money regardless. But there's a massive market for these particular bonds. And what that market is amazing at is predicting what inflation is likely going to be. And right now that market is pricing this inflation at about 3 basis points or 0.03%. It's not saying there's going to be no inflation. It's not saying inflation is going to be 0.03%, of course. We know that inflation is going to be much higher than that. But what it's saying is, look, if you're going to pay me 4% per year to lend me money, well, actually, we think that's pretty much bang on. So the rate at which bonds are being issued, this market thinks is about right at the moment, and it's not spiking. This is the important thing. This oil price isn't forcing this up. So the smartest money in the world doesn't think there's inflationary pressures from this oil spike. And so if it's not inflation, what is it? Well, it's demand destruction, because oil spikes, so costs rise across the board. Petrol, flights are more expensive, like we saw, shipping, food, everything gets more expensive, yes. But if wages don't rise with them, then there's no money supply growth funding these wages. Well, consumers have to pull back. If flights are twice the price, people stop flying. If food costs more, they opt for cheaper alternatives. Walmart and Costco right now are trading at higher price per earnings multiples than Amazon. These things are being priced like growth stocks because they are getting so much more customers, because everyone's going there because they're cheaper. This means businesses see less demand, so they freeze hiring. They might start cutting jobs. And by the way, we just got non-farm payroll data today. That's another jargon word for all of the jobs that aren't for farms. And it was the worst job loss since the pandemic. So the labour market, the job market, is already cracking before this oil shock has even fully fed into the data or fully fed through the rest of the economy. Now, this forces the economy to weaken, right? So oil eventually crashes back down because demand has fallen so much that the price just can't stay up. The cure for high prices, famously was said, is high prices. But the economic damage happens first. And this isn't just hyperbole, I'm not just making this up. This has happened the last 3 times oil spiked. It happened in 2024, oil spiked 23%. Within months, labor data was ugly. The Fed panic cut 50 basis points. Now, maybe you could argue that was a Hail Mary to try and save Biden. Regardless, this is data that happened. In 2008, oil hit $147. This forced demand to collapse and oil crashed back to $30. Again, this came along with the global financial crisis. In 1990, oil doubled after the issues in Kuwait. The economy at this point was already incredibly weak, and this tipped it into recession. And so every geopolitical oil spike without money printing has ended the same way. Reduced demand. And so what does this mean for crypto? This is data from 𝗕𝗃𝗚𝗧's Global Liquidity Index. He was on Risk Takers recently, actually. Please go and check that out. If you want more detail into this and where he thinks Bitcoin's going and when he thinks liquidity might reverse, go and check out that show. We go into loads of detail. Super interesting show. He has been working on liquidity for the last 40 years, and on all his work, he's noticed a pattern, right? And this pattern is that basically liquidity flows on a 65-month, not exactly, but give or take pattern. We just rolled off the peak in October, and we're likely to keep declining, keep going through tightening liquidity phases for the time being. He thinks until the middle of next year. Now, normally Bitcoin sees this earlier, and actually it peaks first and it drops first and it rebounds first, but liquidity is likely to keep looking strained, at least for the time being. And this is the one that really matters. This chart, again, from 𝗕𝗃𝗚𝗧, this shows you global liquidity advanced 13 weeks versus Bitcoin, ETH, and Solana. It's like 60% Bitcoin, 30% ETH, 10% Sol. And again, look at how closely they track. So crypto doesn't follow oil, it doesn't follow inflation narratives. Yes, people pick up these narratives, but fundamentally, crypto follows liquidity. Liquidity is heading down, and it can be just that simple. So short-term, Bitcoin is likely to continue to struggle. I wish I could come here and tell you that it's going to go up tomorrow, but I don't think that is the most likely outcome. I've been bringing pretty bearish content since, well, the end part of last year, really. And to be honest, it's really rubbish to make this content because no one really wants to watch it. Everyone thinks you're wrong. But go and check out all of my shows in the playlist right here. Like, you can find it below. I've been putting out pretty bearish content for quite a while. I don't think it turns around any time soon, but understanding like where these flows come from is really important because it allows you to understand, okay, if liquidity is tightening, if risk assets like crypto are right out on that curve of being so sensitive to the broadening liquidity, if we haven't got that, well, we're likely to see lower prices in the short term. And it just allows you to understand, okay, if I choose to do anything here, any of these decisions, I might be getting better prices in the future. So we're in a low liquidity environment right now, and Bitcoin follows liquidity incredibly tightly. Rallies are likely to be sold off, but the important thing to understand is what is the trend over the next 3, 5, 10 years? Well, what I see the trend as being is continued, maybe slower debasement. Bitcoin's long-term thesis is completely intact, right? If anything, these kinds of crises reinforce it. Governments will eventually have to respond, and when they do, hard assets are likely to be the best thing to perform. You know, gold has been really strong, probably remains to be quite strong here. Bonds seem to be like they're holding up okay. Equities and crypto look like they peaked back in October, and they look like they're in a topping process. You know, the SPX, the NASDAQ, both look like they've kind of gone nowhere for the last 6 months. And typically when that happens, it isn't signs of an incredibly strong market that's going to just push through to new heights. Now, who knows, maybe I'm completely wrong on that. But I do think that a lot of these signs are just saying, look, either we're going to see rotation, energy has been doing obviously incredibly well, or we're going to continue to see weakness more broadly, and the entire thing is likely to just go through a typical midterm year. I don't know if you saw the show back in October, but I definitely said, look, midterm years are pretty bad for risk for assets generally. The SPX tends to do worst on average in midterm years. It's normally what happens. Nothing is surprising about this cycle whatsoever. It's almost bang on. Again, go and check out the show I did with Michael Howell on all of this. Otherwise, thank you ever so much for watching. If you've got any questions, drop them below. Let me know if you want to see more shows like this where I'm going deep into not just crypto stuff, but external stuff that has a big impact on crypto. Or if you just want me to find the next 10x altcoin, then let me know and I'll probably never make a show again because those things don't exist anymore. Anyway, I hope you have an excellent day. I shall see you in the next one. Thanks for watching.